What really matters, as you said, is the nuance in the minutes. And as Tim pointed out, it was just a couple committee members who were open to a rate cut at the coming meeting. Okay, so we're most likely not going to get a cut at the coming meeting. The question is really if we're going to get September and or December, with some officials, some being more than a couple, some officials seeing no rate cuts this year. There's more risk that rate cuts will remain on hold. Adding to the idea that rate cuts are going to remain on hold, many officials are saying it's going to take some time for tariffs to raise prices, and many, which is a significant adjective that's used in these minutes.
We're always looking at the adjectives, right?
That's right. Many are expecting a gradual softening of labor market conditions. So we know that the members of the committee are putting more weight on the inflation mandate. They're expecting inflation pressures to become more pronounced. It's going to take some time. And they are expecting the gradual softening of the labor market, which will allow them to stay focused on inflation in the near term.
Okay, speaking of inflation, officials saw tariffs are still likely to put upward pressure on prices. Stuart, this coming on a day where we heard from Stephen Moran, the White House Council of Economic Advisors chairman, who says there's been no evidence to show that President Trump's tariffs have been inflationary. Do you agree with his assessment?
No. I poured over the CEO's report. They use basically an imputed price index for imports, separate and apart from what we get from the CPI. So it's not like there is this separate goods or core goods import price index that persistently has a wedge to the actual CPI figures that we're talking about. And it's way too early to say that tariffs have had no effect on import prices. When you look item by item within the CPI, and we'll get CPI data next week, it is evident that there are price pressures for things like appliances. There are price pressures for things like electronics. And the members of the Fed are going to be looking at that, as are the staff members.
Hold on, explain that again, because you went over this report from the CEA.
Sure.
What was the math that the CEA used in order to come to this conclusion?
So the CEA attempts to create its own synthetic imported goods price index that is separate and apart from the headline figures that we see in the CPI. That imputed price index looks at the portion of goods that have imported parts. And it then tries to identify a price index that would apply to that imputed set of goods, that set of categories. And that report showed that there is a persistent wedge between the headline CPI figures and this goods CPI synthetic index. But again, it's way too early to use some sort of mathematical model to declare victory over inflation, say the tariffs won't present any sort of inflation pressures. We know that the Fed's internal models look top down and say, what is the average effective tariff rate, which from the time that these minutes were written to today when they are released, the average effective tariff rate went up, right? And so we know the Fed's internal models are going to be marking relatively more inflation today than they did when they were having these deliberations June 18th. And at the time of the meeting, staff members were breathing a little bit of sigh of relief reading from the minutes here. They were marking up their growth forecast and down their inflation forecast relative to what they saw in May. By the time June came around, they saw things as slightly less stagflationary. We know that with slightly higher average effective tariff rates today, relative to June 18th, the Fed's going to be a little bit less easy in their inflation outlook.
Well, it's also easy, like I think about, or interesting, you think about the last jobs report showed strength in the labor market, right?
That's right.
So maybe that also reduces that thought of the stagflationary environment too, or what? Like, how do you kind of continue to layer in everything, Stuart, when tariffs are still a big question?
Well, so we know that many members of the FOMC look at non-farm payrolls and they discount them pretty heavily. The members of the FOMC disregard a significant share of payroll growth that we see because of the BLS's birth-death model, which we've talked about ad nauseum over the past couple of years. The other thing to keep in mind is that members of the FOMC are expecting to see a gradual softening of labor market conditions. And so you might think, wouldn't they be, rest assured, everything is great. The unemployment rate ticked down in the latest jobs report, but it ticked down because of a shrinking labor supply. In the sense of improved balance in the labor market, maybe they could be breathing a sigh of relief, but I would hardly call that a robust and dynamic labor market when unemployment is declining because of weaker labor supply. And furthermore, when looking at the jobs report and thinking about the minutes that were just released right now, wage growth slowed, hours worked declined, and the the aggregate amount of labor income that was reported in the report based on payroll growth, wage growth, and hours growth was about zero between May and June. And so softening labor market conditions are still evident. They should not be necessarily resting easy because of that June report.
All right, so let's get to something that we've all been reading about. First of all, we know President Trump continuing to criticize Fed Chair Jay Powell. Here's, first of all, what he said from the Oval Office. This was yesterday.
He should resign immediately. We should get somebody in there that's going to lower interest rates.
Do you want congressional
Why don't
Republicans
you call for his resignation?
Do you want congressional Republicans to investigate and pursue?
It's okay with me. I think he's terrible. He's always late. But he wasn't late with Biden before the election. He was cutting him like crazy. It didn't help too much, did it?
All right, everybody, that was President Trump yesterday from the Oval Office. And then today, he was out on social media once again reiterating his call for Fed Chair Jay Powell to, quote unquote, lower the rate, and talking about the cost to the U.S. economy by not doing so. Stuart, he says the Fed's interest rate is at least 3 points too high. You have emphasized, right, in the past when he's talked about bringing it down by 2 or 3%.
200 basis points.
Yeah. If that,
also, go ahead, Carol.
well, I was going to say, based on your analysis of the U.S. economy, is the Fed behind that much?
No.
Behind the curve in cutting U.S. interest rates?
I don't
and if
think
so, if we have to cut that much, aren't we like in a recession, depression?
So the argument that someone would have to make for somebody like Trump to make this argument that the federal funds rate should come down by 300 basis points, he's really just looking at something like nominal growth, nominal GDP growth, which was running between 7.5% when the Fed was hiking.
Yeah.
And in the first quarter registered about 3.5% because there was a real contraction, shrinking GDP, and there is still persistent inflation. But the reality is that private domestic final demand growth is still running at an annualized pace. So that's consumption and fixed investment. We're ignoring things like inventories. We're ignoring things like exports, net exports, and the drag from imports. When you look at private domestic final demand growth, it's still running between 1.5% and 2.5% over 2.5 years. And so with inflation risk still skewed to the upside, as members of the FOMC are saying in the minutes, the broad swath of members of the FOMC and the staff see inflation risk skewed to the upside. It's no wonder why they're sitting pat. Domestic fundamentals aren't especially bad, and the inflation risk is skewed to the upside. And when that's the case, it would be a bit peculiar to cut rates going into what feels like a persistent expansion.
You know, I think about the way that the president does want to control the Federal Reserve and the rate environment. And I think of a country like Turkey, for example, and a central bank like Turkey, and we've seen inflation rampant. And Stuart, I wonder just about sort of like, be careful what you wish for when it comes to a central bank not being independent. What would happen if the central bank were to lose independence?
Lose complete control over the back end of the curve.
Explain what would happen though.
Yeah, so if the Fed were to step up and attempt to lower short-term financing costs, which is really where they have the most control, and they were to attempt to inject liquidity into the financial system by, let's say, purchasing bonds, it would ultimately lose confidence of investors more broadly in the market, which matter most for controlling long-term rates. Folks would have to start compensating for anticipated inflation, which would be running considerably higher. If the Fed loses credibility that it is committed to its 2% inflation target, investors have to add in additional inflation compensation to long-run rates, and that weighs on financing costs, that weighs on growth, that weighs on investment prospects. So the Fed capitulating to political pressure is really it's an existential crisis for monetary policymakers. There's a sense in which the president pressuring the Fed has the absolute opposite of the intended effect. If the Fed chairman is going to retain any sort of credibility, the president would be better off by suggesting growth is robust, and so you should keep rates where they are. If he were to actually want the Fed to cut, he should be trying to persuade the Fed that, by maintaining your independence, you would be cutting.